We were kind of expecting, looking at the retail sales numbers and the PMI and the restocking of inventories in China, we were expecting a good number here. But more importantly, I think, as we look into 2014, we're probably the most bullish on China. We think this is there to stay for a variety of reasons. Firstly, some of the structural reforms that were introduced in July by the Chinese government with regards to, for example, tax cuts for microfirms, some of the investments in infrastructure, such as railway, some of the ways in which the Chinese want to tackle the environmental problem, which is a very big theme, as you know, in China. And so we think this is there to stay. Plus, we have to take into consideration that the G3 are recovering. China is a big export market. America is its #1 trading partner. And I think this will foster and see potential growth. We see growth in 2014 of approaching 8.6%. And we are advising clients to take advantage of this in a variety of ways.
That's actually quite above estimates, 8.6%. And Dario, you're not seeing any headwinds really, right? You're seeing basically on a trend that is growth, a steady growth.
Absolutely, absolutely. So we've had, I'll be honest, we have a number of investors that continue investing in the China bond story, looking at playing the internationalization of the currency. But at the same time, we have a lot of investors that have approached us and said, how do we play the equity market? They've seen the rally. They're asking what's next. And so we've come out with a comprehensive product suite to take advantage of the CSI. We'll be coming out with our first U.S. physical ETF in November this year. We already trade in Europe, by the way, the 10 different sectors.
And Dario, you'd rather play more a direct China play instead of going through the commodities here, because if you buy a Rio Tinto, if you buy an Anglo-American, I guess you have that exposure direct to the strength in China.
Absolutely. The commodity angle is a mixed one, and it's a complicated one. We prefer going direct into China and taking a view. Of course, the 20% outperformance since the summer in Chinese equities is hard to replicate with the same time period. But if you take a 12-month view, we think that's really the kind of returns you should be looking at.